Okay, so we're going to talk about volatility today. And if anyone's got any questions, feel free to ask away, preferably at the end, because I've got one monitor up at the moment and I'm struggling to get too much from this. Okay, so apologies for a few technical issues. I live out in the country here in Melbourne, so there's things are just a little bit crazy. But I want to talk today about volatility. Volatility, for those people who saw my previous webinar, is something that I consider to be an incredibly an important part of the trading journey. I think it's the epicenter of markets. And I want to show you today how to use it and use it properly, because it really defines who I am as a trader. If you can see, I think there's probably a little bit of a delay here, but you can probably see how this fits into my trading process. This is my full trading process that I've got here as a pie chart. I want to talk today about risk management and position sizing and how we can use volatility to work that much, much more readily. I want to play some trades. I want to show you on our charts how we can actually identify volatility and how we can use it to enter positions. And as I discussed in the previous webinar, volatility is the true asset class. Whether you're looking at equities, commodities, if you're looking at corporate credit, oil, effectively in that situation, if you're buying those contracts, then you're short volatility. And if you're buying fixed income, if you're buying treasuries, if you're buying gold to an extent, if you're buying the dollar, the Swiss franc, and the Japanese yen, then effectively you're long volatility. So volatility is an asset class, and as the time's gone on, people have used volatility in a much more scientific fashion. Volatility is very much based on statistics and mathematics, and there will be an element of that coming through in this. But I want to show you how you can think about volatility and actually use it when you're trading. I was talking to some clients the other week, professional trader who runs an expert advisor. And he said that his performance through February and March had been very, very poor. And I asked him, as part of his expert advisor component, did he have a volatility component that adjusted his position sizing or got him out of the market if things got too crazy? And he said he didn't. And I said, well, maybe you should tweak your expert advisor to have some sort of EA component that says, well, if the volatility in the market is doing something, then you should reduce your position size, or at least maybe you'll stop further away from the market. Then of course you reduce your position sizing. And I haven't heard back from him yet, but certainly I'm hoping that he'll go around and tweak that, because I believe personally that the risk that we take in the market is subject to the volatility and the movement in the market. And right now, it's just such a brilliant time to be looking at all this stuff now. I mean, if I bring up my chart of Aussie yen, hopefully you can see that's all come through. Can I just make? I just want to see the lag that's come through. Can anyone see my? Can everyone just see my MT4 chart now that's come up? Or is there still or is there now or is there still a big delay coming through? If someone could just let me know that you can see the MT4 chart coming through. No. Can anyone hear me at all? Okay, cool. Wonderful. Right. Okay. Well, we can see here that the risk is clearly coming out of the market. I want to place some trade. I want to place a trade on this Aussie yen trade as we go through the day. Once I go into a bit more depth, but if you have a look at US 500, you can see that. Just bring all these things up. You can see we obviously saw volatility really pick up last night in a major fashion. And one of the things we saw, if we have a look at the VIX index, which we offer to clients, and this is something that I look at very closely, is the implied volatility that's in the market at any one time. My view is that the VIX index is something that everyone should have a look at. And for people who are not familiar with the VIX index, it's something I did speak about, and I put out quite a lot of my research. The volatility index, or the VIX index, effectively is the implied volatility of the S&P over the coming 30 days. Now, there's a calculation that you guys can use, and this is a spreadsheet that I use, and I'll go over that in a moment. But the calculation for you guys, and I think this is really powerful. If you've got the VIX trading at 34.5, let's just change that number. The difference, I'll just explain the difference between our VIX product and the cash market is the VIX product that you're trading with Pepperstone is based on the front month futures as opposed to the spot price. You can't actually get exposure to the spot price, but you're trading it as a futures price here. So there's a slight difference between the two. You're trading this as the front month futures as a CFD. But the way that you calculate this very simply, if we actually put the futures price in, if I put the futures price into my calculation, 31.64. Okay, so what that 31.64% is effectively an annualized number. So what that's saying is over the coming 30 days, the S&P is going to move, but on an annualized basis, it would represent movement of 31%. And what we can do is we can break that down into daily moves. So for people who are trading US equity markets, if you simply divide that number by 15.9, which is effectively the square root of 252. There's 252 trading days in a year. If you get the square root of that, it's 15.9. So the way that you can calculate the daily implied move over the coming 30 days, this is the daily implied average move over the coming 30 days for the S&P, is simply to use this equation. So you get the price that you see on our VIX chart divided by 15.9 and again by 100. And you'll see that the market is now implying a move of 1.99% or 2%. So the market is saying that using options pricing, and they use a weighted blend between options with expiries between 23 and 37 days, that the market is, the S&P here is going to move up or down by 2%. We've also got NASDAQ VIX and Euro Stocks VIX. And again, this is something that I put out to clients on a regular basis just to show the expected movement. So what we can then do is we can get the current underlying price of the S&P, and we can project what the expected move on the day is by just getting whatever 2% is up or down of the current S&P price. And that gives me a range on the day. This is expected by the market. These are using options pricing to get a range of 38.25, 36.76. So that's 2% either side of that. So that's what the markets is implying in terms of daily movement. So we can just divide whatever the VIX price is by 15.9%, and that will give us our daily implied move. That's pretty powerful when we can actually understand what the market's expecting in terms of daily movement. So we go back to our VIX chart here, and again, you can see that we've spiked up. So this is using options pricing to get expected movement in the S&P over the coming 30 days. And if we divide that by 15.9%, we can understand the expected movement. And when we can understand the expected movement in an asset, we can use that to understand how much risk we're going to be taking on. A lot of people will say to me, 31% is probably a little bit too high for me. We've broken out of this range around 27%, and that's probably a little bit too high. Some people love that, especially if you're trading off shorter time frames. But generally, as a rule for me, when I get above 35%, it's very, very difficult to trade off daily time frames, because when you're going to see intraday movements whip around very, very aggressively. And actually, if you have a look at the markets at the moment, what you've been seeing is a situation where, if I go into my Bloomberg terminal here and I have a look at some of the sort of measures that I look at just to see what's really been going on in the froth in the market. As an equity index trader, I really like to see sort of the level of froth that's been going on, and I think that's really what we're seeing now. Is a lot of the froth has come out of the market. We can talk about what's happening in GameStop. We can talk about what's happening in Bed Bath and Beyond, and some of the what's been going on in the retail trading community. But I think this market was poised to correct. I think there was every possibility that we were going to see that. If we have a look at some of the metrics that I look at, the S&P equal weighted market was underperforming the S&P, the market cap weighted market, and that shows me that the market breadth was falling. So the number of stocks that were rising, as with heavyweights, were increasing, and that was pulling the market up. You can see the Russell 2000 as a ratio relative to the S&P had been rising, and it got extremely elevated. So we'd seen small caps significantly outperforming the S&P, and that told me that people were placing this kind of better reflation trade for 2021. How do you do that? You play that through cyclical stocks, you play that through the Aussie dollar, commodity prices. Everyone's expecting better growth in 2021. We want to be long reflation assets, we want to be short fixed income. And as you can see here, high beta stocks were significantly outperforming low volatility stocks, this orange line. Small caps significantly outperforming large caps. Cyclical stocks were significantly outperforming defensive stocks, and industrials were significantly outperforming utilities. Now, I like to look at this as a sign of euphoria in the market. I mean, we can look at put-call ratios, we can look at the level of call options that are in the market going through on single stocks. We can have a look at market internals. The number of companies above their 20-day moving average, 50-day moving average, but all of the signs were saying that these markets were extended. The elastic band had been pulled a little bit too far. If we have a look at one of the key drivers for the market, if this comes up hopefully fairly soon. Takes a little bit of time to load up this chart. What we can see here is we can see the S&P relative to global money supply. I think the correlation speaks for itself. The question is will that correlation break down? You can see through periods of 2018, we do see it sort of pull away, and then it mean reverts and it sort of overshoots, and you saw that again in February. But at the moment, the money supply, the red line there, is continuing to push higher. And as long as that continues to push higher, I think risk will do pretty well. In fact, my base case is that this year we are going to see copper doing quite well. I think the Aussie dollar is going to do quite well. I think growth generally is going to do quite well, but I think it's probably going to come after about March or April time. At the moment, we're in this period of uncertainty. Is the vaccine rollout going to be as efficient as we think it's going to be? And what we're seeing is we're certainly seeing that volatility pick up. Okay, so what I want to have a look today is how I look at the world in terms of volatility and some of the things that we're looking at. This is a spreadsheet that we put out to clients on a regular basis. And the first thing I want to look at is I've pulled all of these numbers from MT4 through a smart trader tool called XLRTD, which you can find here. Now, if I just dump that onto the chart, I can effectively sing with Excel, and I've created this spreadsheet. You don't have to be a brilliant programmer to do it, but one of the things that I do when I come in the morning is I have a look for momentum, and this shapes my world, and this is what we're going to do now. So I can talk to you about all the macro thematics that are going through, but we've seen a pickup in volatility. We've seen a massive pickup in volatility overnight, and I think the world is de-risking. If I go to if I go to this chart, which I think shows really clear insight as to what's been happening, you can see this white line here is the UBS most shorted index. So these are the stocks which have the highest level of short index interest in the market, and you can see really since December just accelerating higher. So because of what we've been seeing in Wall Street Bets and what we've been seeing in GameStop and all this, all the hedge funds are closing out of their shorts in droves. A large amount of this has been because of what we've seen in GameStop. But this is going to change the world. This is going to change the financial markets. If you're a long short hedge fund, you're looking at your shorts at the moment and you're saying, how is this going to survive? how is this going to work out going forward? Because we've now got an entity who are going to target our short positions. If we find out that our shorts have got a large amount of short interest relative to the equity, they're going to go after it, and they're going to push that stock up, and they're going to make us close those shorts. Effectively, they're going to use optionality to do this, and those options will, the market maker will be short gamma and have to gamma hedge or delta hedge, and that's just extending the move. So this short index interest just is one of the most fascinating charts. I think we're seeing a movement from retail traders, and I think they've become put on a more level playing field, and it's an interesting story that's played through. The hedge fund holdings, look at them, they've started to fall. We've got the biggest divergence since the index was created. It was only created at the beginning of 2020, but hedge funds holdings are starting to deplete. And that's a fascinating story there. And what I think has really happened over the last couple of days is you've seen a situation now where the hedge funds are de-risking their portfolios. And if we have a look at the S&P, or go back to the VIX, again, we're looking at implied volatility in the S&P over the coming 30 days. And what I've done is I've looked at it relative to the realized volatility in the S&P over the past 30 days. So this is statistical volatility. So we're looking at movement relative to the average of the 30-day, statistical volatility relative to what's expected from the market. And this to me is always a really big red flag. If you have a look at the blue line there, you can see implied or expected volatility, expected movement in the S&P has ramped up and pulled away from what is coming in as statistical and realized volatility. In fact, we're probably at the highest levels we've actually ever been, even going back to into March times. So the market is de-risking. They're buying put protection. They're buying volatility in droves. I think hedge funds now are de-risking in great size. The question, of course, is now, do we have more of this to go? So what's really interesting for me now is that volatility in the market, especially in equities, has absolutely ramped up. Hedge funds are de-risking. And what we want to do is we want to look at trades that benefit from a potential de-risking playing through. If we go back to our chart of the S&P 500, we can see that huge move down here. We've got a bit of indecision to push lower, but certainly for me, based on the fact that working on daily charts, which we're still not at that level where I can't not work off daily charts because the volatility is too high and we have to look at intraday movements. But you can see that indecision playing through on the doji. If that kicks lower, then I'll definitely be looking to trade shorts. The other thing which we can do is, rather than necessarily just play it through the S&P, is what we can do is we can have a look at correlation analysis. And I'm looking at the Bloomberg chart here, and I'm going to have a look at the correlation between S&P and against Aussie yen. Now I know that if we have a look at the correlation between the two, they're incredibly tight. So do I want to trade? If I believe that there's going to be a down move in the S&P, I've pretty much taken the view that there's going to be a down move in Aussie yen as well. You can see that the Aussie yen is effectively a proxy of what's happening in the US equity market. So I can trade the two. I've got a choice of trading the two. If I have a look at the Aussie yen daily chart at the moment, I think to myself that there could be some still further de-risking to play through in the equity market. Do I want to play it through the S&P, or do I want to trade it through the Aussie yen because it's a proxy of risk? Now, if I have a look at the setup at the moment on the daily chart, we can see that we've had this sort of distribution channel. We've made these new lows. We've come back up, and we look like we're about to break through these series of lows now. Traditionally, what I would do as a day trade, as a trader, is wait for the confirmation for a daily close below the significant low, and that would give me confirmation based on the candles that the bears are in control now, and the probability is we're going to move lower. So what I'm going to do is I'm going to have a look at a setup here, and what I like to look at first of all, is when I come in is I've set up these charts just looking at trend and momentum. And what I've done is I've looked at some of the key assets that I look at, as you can see here. I've looked at this conditional formatting, and what I've set it to do is to understand, is price below the 5-day exponential moving average? I love it when you get that early move and price is below the exponential moving average, the 5-day. When you get those powerful uplifts or the moves lower, you're going to see it hugging and price moving into that 5-day exponential moving average, and that's going to basically cap it. You can see here on this move up, you can see that price comes down into the 5-day exponential moving average, and the buyers step in. And when you get these impulsive moves up, you generally, as a CFD trader, you're looking to ride that momentum. You're looking to try and follow that capital. And you can see that really throughout this period, the 5-day exponential moving average is capping any of the pullbacks that you're seeing there. You can see in this candle here that price fell below that, but then the buyers step back in and it closed firmly above. And again, you see there. So what you're doing is you're seeing the 5-day exponential moving, capping those losses, and we ride it all the way up until we actually get a close below it on this date here. What I like to see in the situation here is that price has closed below that 5-day moving average, the exponential moving average. Now, we may see a situation that price is going to continue to gravitate lower. I don't know that yet. I haven't got a crystal ball. But what I like is the fact that when you do get these powerful moves, you'll find that on these down moves or the up moves is that the price will move back into this 5-day exponential moving average, and the market will use that as a guiding light. It may move above, but it won't close above that level. I use that as a sort of guide. As soon as price closes back above that level, then that negates my position. So I like to use this because what we're doing as short-term traders is trying to follow the capital flow. We're trying to follow that power of money. This is in the early stages, so I like the look of this at the moment. I'm not right every time, but I know I'm going to be wrong quite often. But at the moment, this is shaping up to be quite interesting. We've got this new lower low. We've got price below the 5-day exponential moving average. What we've also got is price. Where's price now? 97.79. We're trading below both the medium-term standard moving average and the short-term moving average. So on my chart, what I've done is I've set this conditional formatting to show me that both are below there. What we've also got is price below the central pivot point. That to me is confirmation that we've got price moving lower. So I don't even have to look at the charts. I can see that the Aussie yen is trading below both those situations. Now I would like the RSI to be below 50. But price is falling, so we know that that's not going to be the case. So immediately when I'm coming in, I'm going to take a slightly negative view. This is guiding me to my charts. So I can see the price below the short-term moving average. I can show below the central pivot point by quite a decent margin. And we've got the RSI, looking like it's probably heading lower. So immediately I'm taking a negative bias on this. What I want to do now is have a look at the volatility. So I like the position. I'm thinking to myself, I want to be short Aussie yen. The question I've got to ask myself is would I be trading now, or do I want to wait for that daily close? This is why we'd probably go into shorter time frames and go into half-an-hour trades and just see what happens here. We're going to wait for the retest here, see how price reacts around those levels. But let's say we're going to place a trade now, which is quite aggressive, because generally I like to see a wait for a close there, but sometimes you miss out on the opportunity. It's really about how price reacts once it's broken through there. But for the sake of showing you how I'll step at, using volatility now to guide my stop loss, I'm going to go to my my volatility chart. And what I'm doing is I'm pulling implied volatility from the options market. Now I'm getting this from Bloomberg, and what Bloomberg do is they get the aggregate implied volatility from all the market makers who supply a price. And implied volatility is derived from options pricing. Okay, and the simplest way of looking at this is overnight or one-day options that expire the next day in Aussie yen are trading at 12.8%. Now that's an annualized number. So overnight options are saying that if we annualize this, Aussie yen would move up or down by 12.8%. Okay, that's an annualized number. So overnight options, the demand for those options will increase if people see expected movement or greater expected movement. The demand will pull back and contract, and you'll get a lower implied volatility if people reduce the demand for those options. Therefore, people are seeing a lower expected move. So movement dictates the level of implied volatility. And right now, what they're saying is on an annualized basis, using overnight options, Aussie yen is going to move up or down on an annualized basis by nearly 13%. Anything further than that is your break-even level. So what I've done is I've looked at this firstly in context of where that is in its 52-week high and 52-week low. If I actually go and chart this on Bloomberg, just to show you how this works, give you some context. And I appreciate that a lot of you are sitting there going, this is quite new to me, but this is, yeah, this is what a lot of funds will use, and I'm just planting a seed on how this works. And this is information that we put out to clients. So I'm just giving you some understanding about how this works on a more real basis. So next time you see it, you'll get a bit more clarity. Okay, so you can see that 12.8%. Okay, so you can see that I've charted this over time. This is taking in real-time prices, and you can see we're at 12.84%. So the annualized rate of the movement is at 12.8 point on Aussie yen. You can see at some stage it's got to 32%. So that's where we're seeing extreme movement. It's like the VIX, and you can see back in February, in March, the market was saying that Aussie yen up or down could move 58% in 1 year. That's a pretty big move. They're now saying it's 12. So it's still one of the highest levels we've seen really since November. So there's a bit of volatility coming back into Aussie yen. But you can see there, if you put it into context, and this is how we do, we like to put context on this. We look at percentile rank. Where is that 12.8 relative to this 52-week low and 52-week high? And you can see it's trading at the 10th percentile. So it's not particularly elevated, but again, that's been skewed by what we saw in March. Now, this is the bit that it gets interesting. This 12.8% is an annualized number, as I talk about. If we divide that number by 15.9, which is the standard deviation or the square root of 252. Remember, there's 252 trading days in the year, and we get the square root of that because volatility is equidistant to to time. So what we're doing is we're getting that annualized number, and we're just dividing it by 15.9, and we're getting the expected move. And that's great because this is a tradable number. This is based on options, but based on this number and dividing it to get a daily number. So this is an annualized number. We're going to bring it back to get a daily implied move, and we do that by dividing it by 15.9. And we can see that the market is implying a move on the day of 64 pips. Okay, so the important thing about this is it's not just looking at what's happened and the past movement. It's looking at what's expected. So it's looking at all the data that's coming out overnight. It's looking at all the event risk, any central bankers who are going to come out, any moves that may happen in commodity markets, whatever's going to happen, all known news or known, and makes a judgment call on it. Okay. And so this is the market implying. So it's rather than me making a judgment call, this is the market making a judgment call. And what I've done is I've used that 64 points and I've added it and I've subtracted it to get an expected range. And we can see that the market is implying a move of 80 to 78.72. Now, the important situation to understand, and this is where it starts getting a little bit tricky, it isn't already, and I apologize, this is where statistics come into play. This is a one standard deviation number. This is an annualized standard deviation number. And for mathematics students out there, for statistics students out there, this is one of the most important situations that you find in a lot of trading. As you can see, this is a distribution curve, a normal distribution curve. And the great thing about this is it shows us that statistically 68.2% of price moves or outcomes will be contained around the average. So if we get a period or an expected period, we know that statistically in a normal distribution, usually contributed by a sideways trending market, that the next price moves are going to, it's about nearly 70% of those are going to be contained within them. This is where Bollinger Bands work really well. You know, what are a Bollinger Band? Well, they're just 2 standard deviations of the 20-day moving average. Why do we use that? Is because we know that 95.4% of price moves are going to be contained within that Bollinger Band, but it's using backward data, it's using past data. A lot of people will use the average true range. You know, a lot of clients use the average true range all the time to understand how much risk they're taking on a position. Well, the average true range is based on statistical data, price moves that have happened. You know, does that necessarily mean it's going to happen going forward? Well, I think there's certainly logic to that. Implied volatility is based on what's happened with a forward-looking view. But there's no indicator that you can get out there that looks forward. And this is where this is quite unique. So what we're doing is we're looking at the price move, the expected price move, with nearly a 70% level of confidence that this is going to be, price is going to be contained within there. And that's what I love about the options market. It's based on mathematics. So there's quantifiable levels and levels of confidence that we can use. So I can go into this trade now thinking I want to go short, and the market's implying a move of 64 pips, which gives me a high of basically 80. So what I'm going to do is I'm going to go to the chart now. I'm going to draw a line at 80 there. So in theory, I am going to be taking on 69 pips of risk in my trade. My stop loss is there. Most people would probably look to leave a stop loss, you know, above these kind of levels here, and that's fine. If you go to the average true range, for example, which a lot of people use, as I say, let's bring it up and put it onto the chart. Let's put a 5-day average true range on there. You can see the average true range is pretty close to where I am at the moment, 65 pips. Mine is, what do we say, 64 pips. So the implied volatility actually in the ATR are pretty much exactly the same in this instance. So that's really good. I'm pleased to know that. So I've got a stop loss where the average moves over the last 5 days complies with the expected move with a 70% level of confidence. Now in trading, let's say I'm going to take a trade now. What I've done is I've created this risk reward, and I do that by manipulating the Fibonacci retracement. So I've done there on there, and you can actually play around this. I can certainly, if you reach out, I'm happy to show you how I do this. But if you right click on that, it's not showing me for some reason. What I've done is I've gone into the Fibonacci, and I've changed the levels to show my risk reward. And I'll give you the formula for that after the webinar if you want to reach out to me, and I'll show you how this works. Now the interesting thing about this, and I want to come back to this because this is absolutely essential. In trading, let me bring up another webinar that I did recently. As you can see here, this is for me one of the most important dynamics in trading, and that's the risk reward trade-off. Okay, so I know that if I'm getting 50% of my trades right, I can risk $1 to make $1, and I only need to get 50% of my trades right. Most clients will go into trading thinking that they're going to have to make 90% of their trades right, or 100%. And of course, that would be a lovely scenario to be in, but of course, that's never going to happen. What we need to do, and what I recognize in my trading, is that I don't need to be right every time. I just need to go into a trade hoping or trying to extract as much out of my trade as I possibly can, that I ride my winners and I cut my losses as early as I can. Now, if you look at the mathematical formula here, if I'm risking $1 to make $2, I can be right 33% of the time. I have to be right, and this is something that Paul Tudor Jones, one of the best traders in the world, talked about, trying to make 5 times what he's risking on every trade. I'm not that optimistic, but what I'm looking for in my trading is to try and be somewhere in right around about these times. So I need to know if in my trade, I want to be trying to get 1.5 to maybe 2 times R in my trade. So going back to that formula, I don't need to be right every time. I just need to try and make 1.5 to 2 times what I'm risking. And that's why this is really important. So let's say my entry point is here now at 79.39, and my stop loss is placed at 79.99 or 80. I've now got a guide which I really want to be targeting down here. Okay, so I've got my stop loss, which has been dictated to by the volatility in the market. That volatility will contract or expand, but it's given me definition by what in terms of market's expected movement. And that's overnight. So the market's expecting a move of 69 points within a daily move. So I've got a 70% level of confidence, or a 68.2% level of confidence that price is not going to breach here. If I want to increase that, of course, I can move my stop loss further away from the market, and I can increase my statistical level of confidence. But I'm going to have to increase my stop loss, and therefore my position size is going to have to be adjusted accordingly. So you can see now, because I've taken a wider stop loss from this position, that what I'm trying to get in terms of 1.5 times R, or we really want to be targeting 78.23, has increased as well. So I've taken a little bit more wiggle room than what the market's implying by my model. But you can also see now that the amount that I need to risk is there as well. So let's say I'm going to place this trade. What I've got is I've got a fundamental reason. I think there could be some more downside in these markets. We know that the Aussie yen is really correlated to the S&P. So I like this trade. If I have a look at the flow of money, if I have a look at the technicals, we can see stochastic momentum is moving to the downside. We can see price is breaking through here. It's aggressive to trade here. But certainly, what I'll be looking at is a situation, if this closed, that would give me a lot more conviction. In fact, for me, if this does close through here and price continues to fall over the next couple of days as volatility picks up, I would actually be looking to add to those short positions, trying to ride it down to this 1.5 hour time situation. The reason I say that is because what I'm trying to do is I'm trying to find a mechanism to really target that 78.23. And a lot of people will start being in a winning position and they'll take that profit too early because they want to be proven right. For me, the best way to try and avoid that is to think and try and change your mindset. When a position's working, you look to add to that position. Don't try and take the position too early. Okay. So instead of actually taking that position too early, you're actually adding to a position. Try and change that mindset. Either way, the idea that you're riding your winners and you're cutting your losses early is absolutely fundamental towards getting to that mathematical equation that we talked about here. We need to be on this side of the ledger, and to do that, we need to think about our risk reward, not just our win rate. It's okay to be wrong in trading. We're all wrong, but it's about how much you're making on your winning trades. And this mathematical formula works for me. I'm going into the trade trying to get 1.5 times R, which means I have to get about 40% of my trades right. Now, how do I do that? I need to extract the most out of my trade. So I've got a stop loss now, which I know I'm taking around about 70 points of risk, and I know that I need to go into this looking for a move down to here to keep that formula working, and that serves me well. Okay, the other one that we can do, so that's the sort of my sort of generic breakout trades if markets are breaking out. The other one which we can look at today, let's have a look at sterling Aussie, because sterling Aussie is doing a similar situation as well. As you can see here, we're sort of breaking through these levels. I mean, I don't necessarily like the pound, but there's a lot of shorts in the pound, and the Aussie has been this big proxy of global growth. It's been the go-to place of reflation. If the world is starting to question that a little bit and we're starting to see a little bit de-risking through, this is a currency pair that I think could continue to move higher. Now, I'm not going to buy this now. and I'm not going to buy this now because I'm concerned that, I have no real strong belief that the pound's a great currency to be long, but I do know that if we do see a continued de-risk and the S&P continues to fall, Nasdaq continues to fall, and the VIX continues to gravitate towards sort of 40%, then the Aussie is going to underperform against what we've been seeing in the pound. And the other chart that which I think is really insightful for me is what's happening in the correlation between the Australian dollar and iron ore. And as you can see in this lower pane, you can see the Australian dollar's correlation with the Bloomberg Commodities Index, which is heavily weighted towards industrial metals. And certainly iron ore is very strong indeed. Now, if we have a look at iron ore, so look at we're looking at Aussie dollar as a proxy of what's happening in its biggest commodity, which makes a lot of sense, right? 35% of our exports go to China, a large portion of those of iron ore. Iron ore's done incredibly well. Aussie dollar's benefited from that. But if we have a look at iron ore futures, they've started to come off. They've started to show some cracks, and I think they were down pretty hard today. China's doing some measures. So down 2.3% in the May contract. So there's a few cracks starting to emerge in iron ore as we go through, and perhaps with that correlation with the Aussie dollar starts to continue to increase. Now, going back to the sterling Aussie chart, it fascinates me. It's definitely one that's on my radar. I don't necessarily want to be long now, but we're starting to see this pattern come through where we've seen this downtrend coming through. Price is holding above the 5-day exponential moving average. We're just peaking out here. So this is on my watch list. You don't always have to trade at market, but we're just now having this on high watch. So tomorrow morning when we get a new candle, I'm going to be coming in. Let's see how price reacts. Ideally, you obviously want to see a breakout, price come back to show this is now support, and again you take your time frame in and just to see how price comes in. But let's say I'm going to be looking to take a long position tomorrow in this. So again, I'm going to come back to my model. Why is this sterling Aussie's not in there? Okay, I need to update that one, but let me go to Bloomberg and let me see what the let's have a look at overnight implied volatility. I need to do that, update that one. Sorry. Okay, so the market is pricing a 34-point move in sterling Aussie. Sorry, 110-point move. So let's have a look at the straddle price. Okay, so the market is saying, so it's a similar situation, which I'll update for the spreadsheet next time. But you can see that the market is saying that over the session, the sterling Aussie is going to trade in a range with 180.33 down to 178.51. So I'm going to use this as my guide. Now, there's a science behind this as well, because this is market makers offering a price, and people can actually buy and sell volatility based on this. So if traders are selling volatility, what you'll end up seeing is a situation once it breaks through these wings, and this is exactly what you're seeing in some of the the high volatility stocks in the US, like GameStop, for example. As soon as price breaks through here, then market makers have to delta hedge their positions. But if I'm going short volatility, expecting price to stay within this level, effectively what happens is that market makers are long gamma, and effectively a price breaks through here, then they have to sell and price comes back in. So there is a science behind this. We can use this because market makers will look to contain it within these levels. So I'm going to say that the upside is 180, so the downside, because we're looking to go long sterling Aussie, is 178.50 or 51. So this is the market's implied expectations of movement by that time. So let's go back to what did we say? 178.51. Okay, so I've got my stop loss in place there, and you can see probably just take it just below this previous low, just give it a little bit more breathing room. And then what I'm going to do is I'm going to put my risk reward profile on here, depending on where we get in, but let's say we get in here. So really, I'm going into the trade knowing that my exit has been defined by the level of volatility and the expected movement in the market, which has defined my stop loss. And my stop loss is defined by volatility. It's defined by movement, and that stop loss is dynamic. But I'm looking for the price to go up to 180.60. So I'm therefore know that as long as price is more right than wrong, and hits that stop loss when I actually do try and get as much out of a trade, that I can be wrong 40% of the time. So that's the logic behind this spreadsheet. What you'll see here are some pairs that I've been trading. You can see the overnight implied volatility. You can see that's annualized. You can see where that is in regards to the range. You can see the expected movement, and you can see what the expected ranges, and that's with 68.2% level of confidence. And then you can take that out if you want to be really sure, and you can get 2 standard deviation move there, which is 95%. The other thing as well as I put out is a weekly implied move. So this is using weekly options, OTC options, which are priced by Bloomberg, and it's looking over at the data over the coming week, and it's giving an annualized number again there. So this gives me the expected movement, or the implied move over the coming week. And what we're going to do now, rather than divide that by 15.9, is we're going to divide it by 77.2. And the reason we do a slightly different calculation there is because there's 50 trading days or 50 or 49 trading weeks in a year, and the square root of 49 is 7.2. Okay, so what we've got is a situation where the weekly expected move now is 96 points in Aussie CAD. The weekly expected move from today, 5 days forward or 7 days forward, is 116 points. So again, I come out on a week and I have a look at the data that's coming out for the week, and I look at the expected move that's implied by the market. And this has got a 68.2% level of confidence, and this has got a 95.4% level of confidence as well. So there is a science to this. We're looking at expected movement, and we're looking at whether the market's expecting these events to be volatility events. The great thing as well about looking at this, if we're looking at, say, we've got the Fed meeting, yes, obviously last night, is the market expecting movement over that event? If I see this overnight implied volatility picking up around an event, I know that the market's expecting movement. Now, your job as traders is to manage risk. Some people will be running expert advisors, some people will be trading discretionary, some people will be trading over the news announcement itself. But for me, I want to know, what is that news announcement? Is it non-farm payrolls, ISM manufacturing, is RBA rates announcement? But is the market expecting movement? And the market, if it expects movement, will buy these overnight implied volatilities. You'll see the implied volatility move up, and you'll look at it in context to that range. And when they don't expect movement, you'll see that implied volatility reduce, and therefore you can make an understanding of whether the market is expecting that economic data announcement or a central bank meeting to be a volatility event, and therefore I can make a sense of whether I want to actually hold the position over that event or not. So this is really good information for me. It's the market looking forward over an event and telling me whether or not they think that it's going to be a volatility event. And that's really powerful, whether I want to make the assumption of taking position out the market, whether I want to increase my position or reduce my position, and it's going to be based on what the market's telling me on expected movement. For me, if the market's expecting too great a movement, I might reduce my position, I might certainly increase my stop loss, or I might close the trade in that situation. So that's really good insight for me. Another thing which we can do using volatility is mean reversion strategy. So what I've shown you is two strategies here where I'm looking for a breakout, I'm looking for an extension of the trend, and I'm looking to ride it, found my stop loss based on the expected movement, and I'm looking for where a target for where the market needs to go based on my theory that I only need to be right 40% of the time, but when I am right, I need to try and hit my profit target, or at least try and go further if I can. The other way that we can look at that is through mean reversion and using volatility for mean reversion purposes. So this is another strategy that we look at very closely. One pair which I think is really worth looking at the moment is dollar yen. Now, one thing we can look at, going back to my spreadsheet, is one which I've pulled up, which is the RSIs. Immediately when I come into this spreadsheet here, which I've basically pulled out all the information from these pairs and where the RSI sits, the 14-day RSI, you could use the 9-day RSI, is I'm really looking for the RSI to be 50, and that tells me that it's mid-range, obviously. So when I look at that, I can see dollar yen around 50, but most of them have sort of had a big move, but they're around the sort of 50 level. But dollar yen, given my macro view at the moment, is that we're probably going to see some dollar short covering. We're seeing that coming through, but I like the yen in times of higher volatility. So there's a bit of a conflict coming through there. Do we like dollar yen? We like the dollar a little bit in high volatility times, but we love the yen a little bit more. And there's obviously a lot of dollar shorts out there that need to be squeezed. So that to me says that there's two currencies which are quite attractive in a risk-off environment. Therefore that could be a good mean reversion currency. And we've got the RSI at around 50 as well. So again, you've got that sort of mid-range. Let's have a look at the chart and see how this is trading. So this is going to be like a mean reversion strategy that I want to employ. Now let's bring up a clean chart here. Okay, so I've got pivot points on there at the moment, but I'm going to take them off. If I have a look at the chart at the moment, it's trending lower. If we have a look at the standard deviation channel, it's quite an interesting one here. You've got the line of best fit. I do like these. These are quite interesting because you've got the line of best fit that goes through that trend that we've been seeing, and then you've got one standard deviation either side of that. So again, that comes back to that distribution. At 68.2% of distribution to contain within that. Yeah, there's skew, and some of the statisticians will say, oh, there's a bit of a skew because it's downside. But you are still seeing a situation where this is coming into the top end of the range. Is this the time now to look to fade it as we go into this channel? Perhaps that's quite an interesting situation. I'm going to delete that. But we can see that now, whether you're looking at a channel or whether you're looking at as a standard deviation channel, there's about a 70% chance that price should be contained within this move. I'm just going to remove that now, but that's got my interest. The other thing that on this dollar yen chart now is that you've got price hitting this double top. Now, of course, you've got the neckline coming down here, but you've got this double top pattern that's in place at the moment. So it's kind of finely balanced. You've got it sitting at the top end of the channel range. You've got it hitting at this double top, but it could be breaking out. We'll have to see. But what I think at the moment is with the RSI around 50, and price having a little bit of a move up, and my fundamental bias is that both currencies could do quite well in a risk-off environment, a sustained risk-off environment. We're going to have a look at more of a mean reverting strategy. So again, I'm going to come back to my volatility chart. and we're going to have a look at the expected move. So the overnight implied volatility is 7.5%. So on an annualized basis, they're saying that the dollar yen should move 7.5% up or down on an annualized basis, and that's got a 68.2% level of confidence. What I'm going to do is I'm just going to show you where that sits, just to show you some context, what that implied volatility looks like over the last 12 months, just to give you a sense. Yeah, I mean, look, it's started to move a little bit higher. So expected movement, implied movement in the currency pair has started to move up a little bit higher. That's not out of range, but it's not, when you compare it to what we're seeing in equity volatility with the VIX, it's it's obviously very low. But we can see now that the implied volatility is pushing higher. I think that's quite interesting in itself, but it's still pretty low. So again, it's leading us to believe that this could be a good mean reversion trade. So 7.5%, it's 10% of the 12-month range. But again, if we get that annualized number and we divide it, because we're getting a day count, divide it by 15.9, and we're saying that the dollar yen is going to trade with a 68.2% level of confidence in a range of 104.75, 103.71. Again, this is not me making a market. This is the market saying we're looking ahead at everything that's going on tonight, throughout the rest of the session, or where we've been, and making a judgment call on the expected move. And there's a science behind this, because we've got market makers who will be able to hedge this as well. So I'm going to go now and actually draw those lines. 104.75 is the top one. Let's use that one there. And then the bottom one, 103.78. Okay, so what we're saying here is that the market is probably going to trade or the market's this isn't actually me, this is the market saying that we expect dollar yen to trade in this range throughout the next 12 hours or so, with a 68.2% level of confidence. The interesting thing here is that it comes right into these highs here. This implied move comes into these highs here. Again, so that works as confidence. What we can also do now is I'm going to put some other indicators on there just to really reinforce my my belief system here. So the first one I'm going to do is I'm going to go to Auto Chartist. This is an expert advisor that you can download as part of the MT4 package. If you haven't got this on your charts at the moment, and if I can get this to work, hopefully it works. Yep. Okay, so what Auto Chartist does is it uses a similar situation, and it projects levels onto the chart, similar to what I've actually drawn here. Now, what Auto Chartist does is it goes over the last 6 months, and it takes every closing level at this time and projects one standard deviation either side. So it's using the prices, all those prices in their library or database, to get the average, and then it projects one standard deviation either side. And again, it's similar to the concept of what I've done, but you can see here that with a 68.2% level of confidence, that they see price 104.67, 103.81, which is very similar to what I've done. The implied expected move based on the options is very similar to what they've come out with their numbers there as well, which I like. I think that's good confluence. What I can also do is, and there's a million other things I can do. I can put the ATR. What's the ATR on the day? Let's have a look at the ATR. 51, what was it, 37 points? What did we say are 49? So this is overstepping the ATR, which I'm fine with that. It's giving us a little bit more breathing room than the 5-day ATR. Just going to delete that. Try and delete that. Let's move that down. So we've got the RSI mid-range. We've got stochastics moving up, but they're still mid-range. We've got Auto Chartist telling us that 104.67 is going to be the high, and we've got my implied volatility model being the high as well. Now, a lot of people will use pivot points. I think pivot points are quite interesting. I don't know if they necessarily give you a statistical edge, but if I go into here, we can see that the high of my range is between the R2 and the R3, and we can see that the low is, obviously it's skewed to the upside, but you can see the low is around about to the S1. I'm going to remove that. Okay, so what I've done is I've looked at the auto chartist expected move, implied move, and I've looked at my implied volatility move, and I can see that with a nearly 62% level of 68% level of confidence, the price is going to move between these levels here. So I'm now going to be looking to trade these as the session goes on. I've got 2 levels on the day, which give me levels of confidence. So I can come in and I can change my time frame into half an hour. You can see price is doing absolutely nothing at the moment. You can see here that auto chartist has corrected itself. I can't actually get that written down. But you can see now that price is really doing nothing. But if it was to move up into this 104.71 level or 103.80, then I have a predictable level of confidence that price is going to be contained with that in the day. I mean, I can use Bollinger Bands, but Bollinger Bands is necessarily backward looking. This is more forward looking at what the market's expecting, and there's market makers hedging when it breaks through these levels as well. So this is where I'd be looking to fade price into the day. I've got a level on the day that I'm going to be looking to sell into levels around here, and I'm going to be looking to buy into levels there on the day as a short-term trade. And that's how I really use that mean reverting model. Let me go back to. So again, we've got these highs coming through at 104.71, and the interesting thing is that sort of coincides with these previous highs, and that to me is where I'd be looking to sell in and looking to fade the move on the day. I'll be looking to make short orders in there, and again using that implied volatility measure there to put stop losses on the trade. So this is where I'm going to be looking to sell into there as well. So really, that's the strategy that I wanted to show you guys today, to give you a sense that using MT4 and MT5, we can create these really cool dashboards to give us a sense of movement. I can come in the morning and I can get a sense of where price is in relation to the 5-day exponential moving average, or whatever the condition is that you want to look at, and that frames my bias. It frames my opinion about what's going on. I can create where price is in relation to 20-day lows, 20-day highs, pivot points, and I can have a look at potential changes that we've seen coming through here. I've got this volatility measure where I have at the beginning of the week understanding the expected movement throughout the week in the assets that I look at here. I can have a look at the VIX, which gives me the expected move on each day, and I can have an understanding that can I handle a 2% move in the S&P, or can I handle a 2.5% daily move in the Nasdaq? Can I handle a 1.9% move in Euro stocks based on these indices? This is the market's expected movement. Then I can go into my overnight implied options, which again we provide to clients. You need a Bloomberg feed, or you need to go to some sort of market maker who can offer this to you, or we will send this out to you as a client, and you'll be able to get this implied move, which is sourced from Bloomberg, and you can look at the expected moves on the day. Now, of course, a lot of people do use average true range and other factors like that, but this for me is more forward looking. It's taking some of that realized movement that's happened and it's projecting moves going forward. So using this expected movement with an understanding about with a level of confidence, I can then project onto my charts where my stop loss should be, how much risk I need to take on, and that is based on the expected movement in the market. And then I can actually work out, do I want to take the trade, and where my stop needs to be, where my risk needs to be, but also I can then use that also for mean reversion strategies. I'll wrap it up there because I think that's I think that's a lot of information to take in. If you are a client and you want the expert advisors, auto chartists, and various factors to help you with the volatility, then do sign up. Do reach out to Susan. If you're not a client and you want information about trading with Pepperstone and trading some of these ideas that we've played out today, get in touch with Susan Fu or myself, Chris Weston, and we'll provide you with more information about how you can do that. I'll give you some details here. So if you do want to sign up and play some of these trades, if you've got any information that you want about Pepperstone as a broker, do reach out to us. If you want the recording, we'll obviously send that out to you as well, because there's going to be a lot of statistical information out there. But I do want to ramp home the idea that whether you're running a discretionary strategy or whether you're running an expert advisor, the market gives you levels of expected movement and statistical movement. And that level of movement that's in the market needs to account for how much risk you're taking on a position. If you're increasing the amount of risk that's in a position, you need to increase the amount of reward that you're looking for. And that means, how do you stay in that trade for that period of time? And that's what I've tried to draw in that situation. But by having a dynamic attitude and an approach to understanding how much risk you're taking on, you can adjust your position size accordingly. And I think that will help you stay in the game for longer. So we're really looking at volatility, not just to understand how the market may act, what assets are going to move, but how much risk we're taking on, what our position sizing is, and therefore how much risk we need to take on. And that's what this spreadsheet hopefully gives you. So if you want to get more information about that, do reach out to Susan or myself. If you want to play some of these trades, or if you want to look at any other sort of trading with Pepperstone, do reach out to us. But we really thank you for joining us tonight. So thank you very much, and I hope to see you again soon.